it's unclear maybe what exactly comes of this, but what are the top things that you think should?
Right. Well, I would prioritize really shortening the settlement cycle from 2 days. I mean, the core of the problem, at least with the disruption and the havoc created when Robinhood had to suspend trading, was a margin call from the NSCC, the centralized the entity that does centralized clearing for equity transactions. So there's a 2-day float. So it's 2 days between when you actually do the trade and when you actually get your stock or get your money. And that creates a risk for the centralized counterparty, in this case, the NSCC. And they have to make margin calls when stocks get really volatile. The risk of one or other side of that trade defaulting increases. So if we went to real-time settlement, you wouldn't have this problem. The technology is there over time, I think, to get there. But shortening that settlement cycle, I think, is very important. Even shortening it from 2 days to 1 day would help a lot with this centralized counterparty exposure that we have, that can lead to these destabilizing margin calls. We also probably need more transparency around the margin itself. There's not much transparency about what the margin requirements at an SEC are. That is probably something the SEC needs to look at as well.
Now, bigger picture, what do you think of what Robinhood really is and what it's doing? Sort of gamifying trading for retail investors, making options trading and trading on margin more fun? There's confetti. Is that good? Is that bad? Does it matter?
It reminds me of to paraphrase Casablanca, we're all shocked that gambling is going on our equity markets. But that's really, it makes it a game. It's speculatively, it's risky. You've got new novice traders coming in, probably not understanding the risks that they're taking. Active short-term trading, time and time again, that's not the way you make money. The way you make money is to thoughtfully invest long-term, put your money there, and keep it there. If you want to get the benefits of this still booming equity market, we're seeing new highs today. Take a page book from Jack Bogle, do the long-term, broadly indexed fund, and watch it grow. This kind of short-term trading may be fun, but it's dangerous, it's risky, and there are always smarter guys on the other side of the trade that are really going to be making the money. The classic case is this payment for order flow. It's a sleazy practice. Never should have, that horse is so far out of the barn. But it's really, it's letting market makers draw order flow by paying for it as opposed to publicly posting the best quote. And they trade in front of published market interests. They trade in between the spread. They make a lot of money off of it. I think AOC hit the nail on the head. It's not really, free trading. It's just less transparent cost. You're losing in the quality of execution. You're not paying a commission to do that trade, but you're losing in the quality of the execution. And those big Wall Street players on the other side of you, they're the ones making money. So this idea that Robinhood is somehow democratizing this and allowing the little guy to take on the big guy, I just don't think that's what's going on. Invest long-term, find real value, find good stocks or broadly indexed funds, and put your money there.
Sheila, there was so much interest in payment for order flow yesterday in the hearing, and I'm wondering if you see payment for order flow being banned, and if that does become banned, what is the impact? Who wins and who loses there?
Yeah, we won't be banned because these traders love not having to pay commissions. They don't understand that they're still paying for it. It's just not transparent what they're paying for. But I think, commission-free trading is here to stay. It's very popular. And I can't imagine politicians or regulators, having the courage to take it on. I mean, AOC had an interesting, maybe we should require that at least 50% of it get repaid to the investors. That might be an interesting idea. Probably a lot of resistance to that too. But it's, it never should. It was, I have a history on this. I used to work for the New York Stock Exchange, decades ago, battling Bernie Madoff on this. It was done in the name of creating competition for exchanges. But that was the wrong kind of competition. The competition should be on who's got the best published quote, not on who wants to pay for order flow.
Shepard Smith here. Thanks for watching CNBC on YouTube.